We're delighted to have started working with Temple Bar Investment Trust and have Ian Lance and Nick Purves on the call to update you on the strategy, performance, and give their outlook for the portfolio. Redwheel won the mandate for the trust in 2020, and the strategy seeks to provide investors with a growing income combined with growth in capital by investing primarily in UK equities with a disciplined, value-oriented investment approach. The trust is managed by Nick and Ian, who we have on the call, and they apply their 35 years experience of value investing to build in a margin of safety while investing in what they regard as good quality yet undervalued companies with strong cash flows and robust balance sheets. I will now hand over to Ian and Nick for their presentation.
Thanks very much, Matthew, and welcome everyone. Thank you very much for joining us this morning. This presentation is going to split roughly into three parts. I'm going to start by giving you a little recap of why myself and Nick believe in value investing. And as you'll know, value investing is very much at the heart of what we do with Temple Bar. Then I'm going to hand over to Nick, who's actually going to talk a little bit about the portfolio and give you a few examples of some of the stocks within the portfolio and try to demonstrate to you how cheap we believe some of these opportunities are today. And then I'm going to finish off by trying to persuade you that in a world that seems obsessed with investing in global equities at the moment, why there's still a case to be made for investing in UK equities. So if we jump in, why are we value investors? We're value investors because there's an awful lot of evidence that suggests that in the long run, value investing produces an excess return. And this chart that you can see here is one of a number of studies which proves that's the case. Normally, there are three factors that people talk about that add value in the long run. Value is one, momentum is the other, and size is the third. Interestingly, factors that don't add value, and I know this will surprise a lot of people because they have worked recently, are quality and growth. But actually, if you think about it, it would be a very strange world in which you got to buy the companies that everyone else loves and you got paid a premium for owning those companies. And I know that's been the case recently, but in the long run, it isn't the case. Whereas, of course, we know exactly why you get paid a premium to own value stocks, because you're owning stocks that everyone else hates, and you have that sort of psychological issue of being able to go against the crowd. But that's in essence why we think you get paid a premium to own value stocks. What's interesting is if you look at the history of value versus growth investing, value has beaten growth in 9 out of 11 decades in the last 110 years. That's what this chart here shows. What's also interesting, I think, is that if you look at the 2 decades in which growth has beaten value, it was the 1920s, the roaring 20s, and the 2010s. And you probably don't need me to tell you that there were some sort of fairly obvious similarities between those 2 decades in terms of very low interest rates and roaring bull markets. But the long run picture is that value has beaten growth in nearly every decade. And I suppose if we move from the theoretical to the real, these are the returns of the Temple Bar portfolio since Nick and I took over. And you can see since inception, the trust is up nearly 74% versus about 40% for the market. So the returns that we've generated so far for Temple Bar shareholders have been very good. But it's also worth just drawing your attention to the fact that by employing a value discipline over the last 20 years, we've been able to add significant value for our investors in other funds. This is our longest running mandate. And again, you can see that we've generated over 400% returns versus less than 200 for the index by employing that same value philosophy. So in the long run, not only does value work theoretically, it works in practice. I'll just add the fact that you can't really see it here, but value does not work always. There are good and bad times. The good times tend to follow periods of marked dislocation. So coming out of the TMT boom, coming out of the financial crisis, and coming out of the pandemic were particularly good periods for us. So it doesn't work always, but it does work in the long run. So let's ask ourselves, why do we think value investing works? And very simplistically, we believe that value investing works because most investors have a nasty tendency to extrapolate the past into the future. And what this chart here comes from a study, and what you're actually looking at, they divided the US stock market up into 10 deciles by growth rate. So over on the right-hand side, we've got the fastest growing companies. Historically, over on the left-hand side, the slowest growing companies. And the figure that you're looking at is the valuation at the end of that period. And this sort of proves the point that investors extrapolate, because what you can see here is that the companies that have grown the fastest historically had the highest valuation at the end of that period, therefore suggesting that investors were expecting that growth rate, that higher growth rate, would persist into the future. And so now let's look at whether that is a good assumption to make. And what this comes from the same study, and what this one does is it basically just looks at how long these growth rates can persist. And the study simplistically in year one divides the US stock market into those which have grown above the average and those which have grown below the average. So in the year one is 50-50. And then year two is basically the companies that were able to carry on doing that in the second year. Now, if we start with the bottom line here, if there was no persistence whatsoever, if it was pure chance, then the figures would go 50, 25, 12, 6. Now turn your attention to the top line. What are the actual figures? The actual figures go 50, 25, 14. So in actual fact, the real figures are very, very similar to base, therefore proving that actually there is very little evidence that companies on average can produce above average levels of growth for a sustained period of time. And therefore that assumption that where people pay up for high growth rates is on average a wrong one. And in the stock market, that tends to produce this sort of pattern. So the thin green line here represents a share price. The thick line is basically the value of a company. And what investors tend to do is during good periods, they will become very euphoric about things. They will extrapolate growth rates forward, and they'll end up paying very high valuations for businesses. And as we've just seen, there are very few businesses which will live up to those expectations. But that's also the case at the bottom. So at the bottom, investors become very depressed about things. They will often put very low valuations on either companies or sectors or often whole markets. And they will end up valuing things well below their intrinsic value. And that is the opportunity for a contrarian value investor. When people are becoming very depressed about an opportunity set and they're driving their valuations down further than is warranted by the intrinsic value of the business, that is the opportunity for people like ourselves. And we'll come on and see later on, there are plenty of those sorts of opportunities around today. There are different reasons why people can overreact, why investors can overreact. I think the one over on the left-hand side is probably quite pertinent today. People have a tendency to overreact to the economic cycle. So when we go into an economic downturn, or even if we think we're about to go into an economic downturn, people react quite predictably. And what they'll do is they will sell cyclical businesses. And they will often sell them quite aggressively. So you often find that going into an economic downturn, anything cyclical will lose 50% or so of its value. And of course, when you think about it, if you buy a business, you're buying a long stream of cash flows. And actually, the fact that those cash flows might go down for 1 or 2 years in an economic downturn really doesn't change the long run intrinsic value of the business. And yet the share price will go down very significantly. And that, as I mentioned a couple of minutes ago, provides a big opportunity to buy businesses at well below their intrinsic value. And we find the same as a function of other mechanisms of overreaction. So the capital cycle would be one. Industries like energy and mining tend to go through boom bust periods, and share prices will quite predictably follow those boom bust cycles and again provide opportunities for contrarian value investors to buy at a point when those businesses are significantly undervalued. So that really sort of ends the, I suppose, the discussion on why we think there's still a strong case for value investment. I'm going to hand over to Nick now. Nick is going to try and bring that to life by giving you a few examples.
Great. Thanks, Ian. Go for it. You won't need me to tell you that UK equities have been extremely out of favour for some time now. As we head into July, it's interesting, isn't it? I think, year to date, I think I'm right in saying that the Nasdaq is up over 30% in that first 6 months of the year. I believe the FANG stocks, which obviously are a large portion of the Nasdaq, is up around 70%. European equities up around 10%, and then UK equities up just 2%. And that really continues a trend that we've seen for a number of years, whereby UK equities have been significant laggards generally. I suppose the obvious question is, why is that? Difficult to know. It could have something to do with Brexit. It may have something to do with the relatively lackluster performance of the UK economy. It may simply be because many investors have been correcting probably what was quite a significant home bias. But the end result is that UK equities have underperformed quite dramatically. There's also, we feel, been quite a significant moves in markets overall over the last few years, away from cyclicality towards predictability and sustainability and stability, of earnings. And again, it's difficult to know why investors have so aggressively sought out that predictability, except to say that the value, as a result of this move, the valuation premium that's now being accorded to the more defensive names in the market, the companies that provide relative stability, we think that premium has reached levels very overextended levels. Now, of course, the Temple Bar Investment Trust is a UK based investment trust investing predominantly in UK equities. The trust today is between 75 and 80% invested in UK equities. And of course, within the UK equity market, we are looking to invest in the most undervalued names. And because cyclical stocks have been relatively shunned within the UK market, within a market itself, which has been very out of favour, it shouldn't surprise you that the trust is quite significantly overweight in the more cyclical areas. So perhaps the position sizes, the positions here, or the sector exposures that jump out at you are energy, just under 20% of the trust, financials around 20%, industrials around 10%, materials, again, just under 10%, consumer discretionary between 10 and 15. So the trust does have quite a heavy cyclical exposure in what we say we believe is an extremely undervalued market. Ian said earlier that obviously we have been able to add considerable value for our clients over time. Of course, it's by no means been a smooth ride. There are certainly periods within that 20-year period that Ian was showing you where our investment style value stocks have struggled. The times we have tended to do best, as Ian said, is coming out of periods of dislocation, where one part of the market, for whatever reason, is looking very lowly priced, and another part of the market is looking highly priced. That's often that has in the past proved to be a fertile hunting ground for us. And, it's not an exaggeration today, we think, to say that we see pretty extreme dislocation in markets today. And this is to do with, as I say, UK versus overseas, and also within the UK, cyclicality versus relative defensiveness. Just go forward. Try and prove this out. This is the top 10 holdings within the Temple Bar portfolio. As you can see, we run relatively concentrated position sizes. The top 10 positions within the portfolio make up close to 50% of the overall fund. Look at some of the price earnings ratios. These are 2023 price earnings ratios. If you quickly tot them up, you'll see that 6 of the top 10 are standing on price earnings ratios of around 6. 2 are standing on price earnings ratios of around 8. And then just 2 are standing on price earnings ratios of more than 10. And of course, those companies, most of them are paying some pretty attractive dividends along the way. So, when we talk about extreme dislocation, we really don't think that it is an exaggeration. It's worth thinking about what a price earnings ratio of 6 represents. If you obviously P over E, turn it on the head, it's an earnings yield, it becomes an earnings yield. Price earnings ratio of 6, of course, is an earnings yield of around 15%. And again, worth reflecting on what that represents. An earnings yield of 15% to the extent that those earnings are converted into cash flows. And we like to invest in companies where those earnings are invested in cash, turned into cash flows. To the extent that those earnings are turned into cash flows, the company could return up to 15% of the market capitalization in any one year without altering the shape of the balance sheet or under investing in the businesses, because of course these cash flows are struck after capital expenditures. And the companies themselves may choose to return this capital to you in the form of a dividend. And as I say, that the dividend yields on a number of these stocks are looking extremely generous. Or the company may choose to return the capital in the form of a share buyback. And clearly, if a company returns 5% of the market capitalization through a buyback, what it means is that next year there are 5% less shares in issue. And what that means is that the earnings per share and the dividend per share increase by 5% for the same pound or dollar outlay. So I suppose what we're saying is that lowly value companies that generate cash and have good balance sheets have the ability to generate their own returns, very attractive returns. And again, compare those sorts of earnings yields, so an earnings yield of, let's say, 12 to 15%, compared to the earnings yield of a company, a more defensive name, with more stable cash flows, which might be on a price earnings ratio of 25 times, where of course the earnings yield is 4%. And of course, we recognize, all other things being equal, a more stable business should warrant a higher valuation. We simply question the degree, the extent to which the more defensive names have become so much more richly priced. We think, as I say, cyclicality is being very underpriced in what is an underpriced stock market. A question we get asked a lot is, people recognize that these companies are looking very lowly valued. I think a question we get asked a lot is, yes, they may be lowly valued today, but I can't see them being re-rated. What do you think the catalyst might be? And our answer to that, of course, is twofold, really. One is the obvious answer, which, of course, is we don't know what the catalyst is going to be. The second point to make is that because companies on low valuations have the ability to generate their own returns, healthy returns, by returning capital to shareholders, you don't need a re-rating in order to enjoy, as I say, the sorts of returns that the trust shareholders are looking for. So BP could, in theory, generate a 15% return in its own shares if it returned all the capital that it generated in 2023. If the shares happen to be re-rated from a P of 6 to a P of 8, of course, that's an additional 30% capital return. So from a low base, we think that these companies really are poised to deliver very attractive returns in the future. Now, of course, I suppose an obvious question is, because these companies operate in quite cyclical industries, and we can't be sure, obviously, 1 year to the next, what level of earnings a particular company might generate. An obvious question might be, well, how can you value these businesses with any sense of, with any level of confidence? And I think what we come back to there is we would just remind you of the importance, perhaps, of using this concept of normalized earnings, rather than valuing the business on 1 year's profits, which may be unusually high or unusually low, depending where you are in the industry cycle. We go through each of the companies in the portfolio and ask ourselves, what would you expect the company to generate in a normal year, if there is such a thing? And of course, we try and value the companies off those levels. So for an energy company, we might use $60 to $70 oil, which is what the level of, which is the oil price that the companies themselves use for planning assumptions. For a bank, we will use a cycle average level of loan losses, as they often guided by the banks themselves. And what's really important to us is, of course, is that the valuations not only stack up on today's level of profitability, but on what we would define as a more normal level of profitability. It might be that actually, for this cycle, the banks are making a level of profits today which proves to be unsustainable, because perhaps maybe deposit betas increase, for example, and there's been a lot in the news about that. But please be confident, please be sure that the companies here absolutely stack up on, look very attractively priced on a normalized level of earnings. And also try and demonstrate that. I suppose I'd use two examples. On page 13, I use the example of NatWest Group. So NatWest Group, share price today is around £2.40. The company is expected to report earnings this year of around 45p. So you can do the maths there. So it's a price earnings ratio of less than 6 times. But again, as I say, it might be that 45p of earnings is struck at a particularly optimal time in the banking cycle, where the companies have been able to benefit entirely from rising interest rates on their lending without having to pass through the effect of rising interest rates to their depositors. It might be that 45p in 2024 is not sustainable. Again, which is why it's so important in our minds to value these companies on a normalized level of earnings. NatWest themselves, it's a conservatively managed retail bank, which targets a 14 to 16% return on tangible equity on a tangible equity base of around £2.70. Again, you can do the maths. That's a cycle average. And when they say cycle average, what they mean there is a cycle average level of loan losses, which is between 20 and 30 basis points per annum. If you work those numbers through, you get an earnings base, a normalized earnings base of circa 40p. So the shares today stand at around 6 times the current year earnings, and less than 6 times current year earnings, and around 6 times what we see as the normal level of earnings. Of course, in a company where the capital base is very strong, where underwriting standards are much improved, and the returns policy is extremely attractive. The company returned over 20% of its market capitalization in 2022. So obviously it's just one stock, and I'm not going to go through all the stocks in this sort of detail. But you can see where we're coming from. We would ask the question, why would you not take a pretty secure 15% return in a company like NatWest, instead choosing what we think is it's a more secure but not completely secure 4 or 5% return in a more expensively priced overseas stock, which may have more stable levels of profits, but certainly doesn't offer the investment return from today's starting point. You know, I'll go through international. So I'll go through Marks and Spencer, probably is the next one. Marks and Spencer is one of the biggest holdings in the portfolio. It's again a company which we think highlights the importance of thinking about not today's level of profitability, because Marks and Spencer, as you know, up until recently has been struggling for some time, but asking yourself, what could the level of profitability be given the company's market position, given the industry in which it operates, in a relatively normal operating environment? And we deliberately include Marks and Spencer because actually we think it's a good news story, to the extent that after many years of struggling on the high street, a high street itself, which is obviously a very difficult operating environment, whereby the company was losing market share and seeing its sales base goes backwards, we think that finally the sleeping giant has actually awoken, and the company is now has quite consistently for some time been taking meaningful share in both clothing and food. You probably can't see the numbers on the bottom right hand side there are quite small, but this is essentially our calculation of the earnings power of the business. The company has a target of taking an additional 1% market share in clothing and an additional 1% market share in food, and it is well on the way to meeting both of those targets. It also has the target of achieving sector average, and that's the important phrase, sector average profitability ratios in both food and clothing. So in food, that's around a 4% margin. That's pretty similar to Tesco. And in clothing, it's around a 10% margin, which is very similar to Next in-store profit margins and also Primark profit margins. And also if you go overseas, a company like Hennes and Mauritz, for example. What we're trying to say is that those targets shouldn't prove too much of a stretch. And if you work through the numbers, you get an earnings per share of around 25p. We actually think that we don't think, yes, Marks and Spencer had been mismanaged for some time, but we actually don't. And obviously, the high street is obviously a challenging environment in which to operate, but we actually think that Marks and Spencer is not a bad business, and that accordingly, it should be valued a multiple, let's say, of 12 to 13 times earnings. And of course, you can do the math to realize that gets you to a share price of over £3 at a time, of course, when the shares are sitting at under £2 today. So another example where we think there's meaningful upside. Obviously, we'll be taking more questions later, but I'll probably, as far as the portfolio itself is concerned, I'll probably leave it there for now.
Great, thanks, Dick. I'm going to conclude by trying to convince you that there's still a good case to be made for UK value. I don't know if any of you listened to Marion Somerset Webb's podcast. She's described UK value as the trade of the decade, and obviously we would agree with that. So let's try and convince you of that case. The starting point, I think, is just to point out how expensive the US stock market is. This is a very long run valuation measure. This is basically a market cap to GDP type valuation measure of the US stock market. The US stock market today is more highly valued than it was in 2000, more highly valued than it was in 1929. I mean, literally, there were just a couple of months, a year or so ago, when it was more highly valued than it is today. And yet, because it's gone up so much, it now represents 70% of MSCI World. And because lots of investors now benchmark themselves off market cap weightings, lots of people will have 70% of their clients' equity exposure in this market, which has basically never been more expensive. Some of you might have heard of an American fund management company called GMO, and the one of the founders of that is a chap called Jeremy Grantham. He recently identified the US stock market as the 6th super bubble in financial market history. A super bubble, as they define it, is something that has moved 3 standard deviations away from its long run trend. So, as bubbles go, this is a big one. And frankly, I would not feel very comfortable having 70% of my clients' money in it. Sometimes you'll hear people say, "Oh yeah, but it's just technology." Believe me, it's not just technology. So what we've done here is we've broken the US stock market up into 10 valuation deciles, so most expensive stocks at the top and the cheapest stocks at the bottom. And I was just simply pointing to the fact that even the cheapest stocks are more expensive today than they were in 2000. So it's not just a TMT issue, that the whole market, the whole US stock market is very expensive. And to explain what this chart is, this chart simply maps valuations across the bottom and then subsequent 12-year returns across the side. And what you can see here is that there is an incredibly close inverse correlation between starting valuation and subsequent returns. In other words, when you buy the stock markets when they're very expensive, your subsequent returns tend to be very low, and vice versa. And what we've done here is we've helpfully identified what the US stock market valuation today. You can see that in the bottom right-hand side. The US stock market today is basically priced to give you -2% per annum nominal returns for the next 12 years. So you're taking an awful lot of risk to give yourselves, potentially very low returns. So let's flip from that into the UK stock market. Why, if you believe that low valuations is a good guide to subsequent returns, then the UK stock market would definitely be a place to look today. The chart on the left-hand side is the valuation of the UK market relative to MSCI World. I'll just point out that that's a 50-year chart. So that goes all the way back to the 1970s. The line going across the middle is the average. So on average, over that 50-year period, the UK stock market traded at about a 17% discount to MSCI World. Well, last year we got down to about -45% discount. So the UK stock market really was at a huge discount to MSCI World. And I know lots of people will say, well, it should be, because of the sector composition. The UK stock market's got more financials and energy and mining, and the US stock market has got more technology stocks. But actually, if you look at the chart on the right-hand side, this simply looks at the discount of the UK sector relative to its US equivalent. And the point to note here is that even in global sectors, the UK stocks trade at big discounts to their US peers. If I give you an example, the third one across there is the energy sector. We saw earlier on that UK energy stocks like BP and Shell trade on price earnings ratios of about 5 or 6 times. Their US equivalents, Exxon, Chevron, trade on about 11 or 12 times earnings. So literally about the half the rating for what are essentially very, very similar businesses, which to us makes no sense at all, and actually is a valuation opportunity. This is the valuation of value stocks versus growth stocks in the UK. And again, just drawing your attention to the fact that it's a 50-year chart. And just look where we are today. I mentioned at the start of the presentation that we tend to do quite well coming out of periods of marked dislocation. Well, compare today's dislocation between value and growth stocks to 2000 after TMT. We have a wider spread in value and growth stocks today than we did in 2000 at the height of TMT. And, as I said, coming out of that period, we generated 5 or 6 years of very attractive returns. I know inflation is an issue that's going to be on a lot of people's minds. We're not macroeconomists. We don't make forecasts for inflation, but we simply point out here that inflation doesn't tend to just go up and go away. If we take the example of the 1970s, we saw that it was lumpy, that inflation went up, it went down, but then it went back up again. And you can see the impact that had on the S&P 500 across that period of time. So I suppose inflation just creates quite an uncertain environment for investors. And I think what the market appears to be doing at the moment is assuming that inflation's just gone away, that therefore interest rates are going back down to zero, and therefore we can just all go and buy the stocks that did well with the last time interest rates were zero, i.e. the US technology stocks. We simply don't think that life is that simple. And actually, if you do look at what happened during the 1970s, if you make the assumption that there's at least a chance that this decade might be somewhat similar to the 1970s, it's interesting to note on the left-hand side here that the US stock market just about kept up with CPI across the decade, but actually you had some pretty nasty drawdowns. So that sort of 72, 74 period, you had a 50% drawdown. If you look at the top line there, that's the performance of US value. Now, US value did very, very well throughout the inflationary 70s, and there were two reasons for that. The first reason is that coming into the decade, US value, a bit like today, was very, very cheap, and it was cheap for similar reasons to today, which is that whereas today we have our FANG stocks in the late 60s, early 70s, we have what we'll call the Nifty 50. So the sort of growth darlings of the US stock market that people were paying very, very high ratings for. And on the flip side, we had I suppose the value sector, which nobody wanted to own. And of course, actually that performed very well through the 70s. The second factor, and again, I think this is pertinent today, is that value bucket, of course, was made up of companies which did well in an inflationary environment, so energy companies, mining companies, etc. And over on the right-hand side, I'm just illustrating here how badly the Nifty 50 did through the 1970s. They actually did a lot worse than the US stock market, not necessarily because the companies themselves did badly, but just because they were so expensive at the start of the decade and they derated so brutally across the decade that the returns to investors throughout the 1970s were very, very poor. And again, I would just highlight that to people who are out chasing stocks like Nvidia on 35 times sales today. When these things derate, it can be a very, very punishing experience for investors. Final couple of slides. This just shows you that markets where the currency has been weak tend to do well afterwards, and vice versa. And obviously, again, I would just highlight the fact that sterling has been quite weak over the last few years, whereas the US dollar has been quite strong. So that would be another reason, I think, in favour of UK equities. And the final point before I conclude is just that simply if dividend yield is something that you're interested in, the UK market has a huge advantage over the US market. The UK market today yields around about 4%. Versus the US market, which yields about 1.5%. So the US market has basically got to provide a big excess growth rate in order to make up for the yield discount that it stands on to the UK market today. So that really concludes the presentation. I'm very happy to take any questions that you might like to throw at us now.
Brilliant. Thank you both so much for that. We've got quite a few questions. Could I just remind people to use the Q&A button at the bottom to type any questions you may have? What is your portfolio turnover or average holding period? Is your main reason for selling a holding when it reaches your price target?
It's probably, as you would expect us to say, it's a long holding period. It's always... We were slightly worried about giving average turnover numbers because it varies very significantly from year to year. what we tend to find is that periods of extreme dislocation, turnover levels go up very significantly, and that was the last obvious example bit was during COVID. It was during COVID, valuation differentials blew out very significantly, and we rotated the portfolio pretty aggressively to take advantage of that. And then you tend to get quite long periods where there's very little turnover as we try and harvest what we hope is the excess return to come from the positions that we've taken. So if you had to put a number on it, 15% per annum would be probably a reasonable number. So maybe turning the portfolio every 6 or 7 years. But turnover recently has been very low, because we think and hope that we're in the stocks that offer the extreme value. The most common reason for selling out of a stock is to recycle capital into what we think are more attractive areas, and typically out of companies which perhaps have done relatively well, and where the hope for improvement in earnings and rating has come through. It's very important to say, however, that we recognize that there is a very large, when we form a view of the intrinsic value of a company, we recognize that there is a very large margin of error, not only surrounding the earnings of the company itself, but also the multiple that the market will go on and attach to it. So we very much try to avoid using intrinsic values as basically sale price targets. If a company reaches our view of intrinsic value, that normally prompts a review of the company, not an automatic sale.
Brilliant, thank you. Consistent with your thesis about UK ratings being so low relative to international markets, buying UK businesses, multinational businesses on UK ratings makes sense. Do you measure the percentage of revenue from portfolio holdings that is generated overseas or domestically?
Yes, it's difficult to be precise because obviously it varies. Actually, we tend to look at profits rather than revenues. But we think between 50 and 60% of the Temple Bar portfolio profits are generated overseas. And, the question is exactly right. I mean, you can understand, can't you? You could, where you have an overwhelmingly domestic business, you might not agree with it, but you could understand the narrative whereby investors could say, well, I'm only going to accord Marks and Spencer a P of 11 because it's effectively a UK business, and I have a very, very negative view on the UK economy, and accordingly, I'm prepared to attach a much higher multiple to an overseas retailer. Where it's really difficult to understand an argument is where you have, as you say, international businesses. So, why there really isn't any obvious reason as to why Shell should be on a P of 6 and Exxon should be on a P of 11, because they are ultimately, at the end of the day, very, very similar businesses, both obviously with international exposures. If you look at investment banking, Barclays, which again, through its investment bank and actually through lending in the US, derives a significant portion of its profits overseas, and yet that company trades on a PE this year of 4.5 times, believe it or not. Goldman Sachs, which is the most troubled of the US investment banks, trades on a P of 11 or 12. Morgan Stanley trades on a P of more than that. So there are examples where you have very similar businesses with very similar geographical footprints, and yet the UK listed company seems to be being penalized for no other reason that it happens to be listed in the UK. And of course, while that's frustrating, of course, in a way, it of course it at the same time is exciting, because it gives us confidence that there's nothing fundamentally wrong with the business in the UK. It simply seems to be that because the selling of the UK over the last few years and months has been so aggressive, it's pushed down what we see as perfectly good businesses down to very, very low multiples.
In relation to financials, how worried are you about bad debt, especially with the change in the mortgage market and interest rates going high at such a fast rate?
Oh, yeah. Is it likely that bad debt levels will increase from the very low levels that we're seeing at the moment? Absolutely, yes. Pretty much all of the banks reported in respect to 2022 virtually zero level of loan losses. And I suppose that's why I was trying to illustrate the importance of thinking about cycle average loan losses when averaging the companies, because the profitability or the return on equity is very sensitive to the level of loan impairments in any one year. Do we think that loan losses will increase off a very low level? Absolutely, we do. Do we think, and will that bring down profitability in that particular year? Yes, of course it will. The key question, however, is whether the companies themselves are lending sensibly and whether their balance sheets are in good enough shape to withstand a very significant pickup in the level of loan losses. And of course, you'll be aware that every year the Bank of England conducts some very rigorous stress tests on these companies, and the assumptions that they use are pretty aggressive in respect of a particular economic downturn. And the problem in 2008 essentially was that these companies, because their balance sheets were completely wrong going into the financial crisis, they were not in a position to lend through the financial crisis. And that is effectively what exacerbated the credit crunch. And the regulators see it as their mission to make sure that that never happens again. That the banks, even in a severe stress, will be able to continue to lend. And that's what we saw during COVID. So, it's easy perhaps, isn't it, to look back on COVID and say, well, that was no sweat. That wasn't something to worry about. But at the time, 3 years ago, we absolutely weren't saying that. The banks were taking significant provisions in 2020 for loan losses that they thought might come down the pipe. Now, they never actually appeared. So actually, a lot of those provisions have now been written back. But the point is, they took heavy provisions in 2020, and yet all of the banks were able to continue to lend because their balance sheets are in a much better place. So yes, do we worry about an increase in loan loss provisions? Of course, and it is likely to happen. Do we worry that these loan losses are going to impair the earnings capability of the bank, thereby impairing the value of the investment? No, we don't.
And I guess I would just add one final point is you've got to look at what's priced into them. The reason that these things are trading on 4, 5, 6 times earnings is clearly because the market has taken the view that the earnings are going to fall very considerably, probably because of rising impairments. So it appears to us to be priced into the shares.
Brilliant, thank you. There's been a huge rise in M&A activity in the UK market from overseas companies, private equity and trade buyers. Are any of your large cap portfolio constituents, in your view, of such value that might see them become targets for some corporate action? And is there any significant advantage in moving down the capitalization scale in terms of mispricing, perhaps?
I think we're already seeing that. Standard Chartered, didn't it, received an approach from First Abu Dhabi Bank at the beginning of the year. That that didn't come to anything. But I think highlighted the strategic value of a bank like Standard Chartered, which of course has got a very attractive geographic footprint. You'll perhaps remember that at the end of 2021, beginning of last year, Pearson got 2 approaches from Apollo. I think between £9 and £10 a share. The share price today is around £8, I believe. Again, highlighting that, yes, Pearson's had its fair share of problems over the last few years, but actually underneath it all, it's actually a pretty good business in a pretty attractive market. And Apollo clearly could see that, and they effectively tried to take the business on the cheap. And we're pleased that the management actually turned down both of those bids. Do we think we will get more bids? Yes, we do. Although it is likely to depend on the economic backdrop. Unfortunately, company CEOs tend to be quite pro-cyclical. So they tend to make bids when actually economic conditions are good and share prices are higher. But do we think more bids are likely? Yes, we do. With regard to the question of, on that basis, are you more likely to find rich pickings in mid and small cap? Yes, I absolutely think that's the case, actually, because there are certainly, a good number of stocks in the portfolio which simply can't be bid for because of their size. However, we don't actually buy into the narrative that the valuations in mid and small cap are particularly more attractive than they are in the large cap. As I say, if you look at those valuations we were talking about earlier, we find it difficult to imagine that those sorts of valuations can be beaten, to be honest.
Thank you. Do you have any views on the impact of increased passive investment flows on price discovery, talking about buying stocks at the right price?
Yes, yeah. I mean, I think it's been an absolute disaster for price discovery. We take the example of the US market, where I think this is probably most prevalent. And Nick mentioned earlier on that the FANG stocks are up, what was it, 70% or something year to date. I think a lot of that has been driven by passive, and it's not just passive going into S&P 500. It's ETFs as well. And I think one of the things that people have to think about is that although those large companies might be sort of several hundred times the size of the bottom end of the S&P 500, they're not several hundred times as liquid. I've seen some research recently suggested that they are probably about 5 times as liquid. And so what you're getting is the money going into those index funds, basically but chasing those stocks which have become a bigger and bigger and bigger part of the S&P 500. And yet on their liquidity is not increasing. And so what it's doing is it's just squeezing up the share prices of them. And that money is completely and utterly valuation agnostic. There's an algorithm that literally says, right, we've had $1 billion in, buy, and it does not care about valuations at all. And that's why we've seen, one of the reasons I think we've seen the valuations of those things squeezed up so high. We were looking this morning, funnily enough, at Apple, which, believe it or not, the market cap of Apple first went through $1 trillion in 2019. And then since then, it's gone 2 trillion and 3 trillion. And the earnings have certainly not gone up threefold. So people are now quite happy to pay over 30 times, or to put it another way, actually, they're just not looking at valuation. I think you have to realize that two things. Eventually, we think that valuations do matter. Eventually, you do get to the stage where some people are going to look at the sort of nosebleed valuations of things like an Nvidia, and that they don't just go up forever. The second thing that slightly worries me, actually, is if one ever got to the stage where that passive money started to go in reverse and you started to see money come out of those things, I can't even imagine where the bid is going to be for some of them, because it's unlikely that you're going to have a lot of active money on the other side willing to step in and pay those sorts of valuations. So, you could see some of those sorts of companies fall pretty rapidly if ever those passive flows went into reverse.
Brilliant, thank you. We've spoken about the portfolio, but have you had any potential investments which you have rejected recently, which are optically cheap but structurally challenged, either always been in having a structural challenge, or perhaps post-lockdown, post-COVID, have any structural changes happened that just make you reassess these companies?
I suppose the one area where we are perhaps an obvious omission from our portfolios is tobacco, and it is, a good number of value investors obviously do hold tobacco. I think clearly we can see that optically the valuation ratios look attractive. I think, but the reason we absolutely have not gone for tobacco is because we think that the profit pool from tobacco is likely to be smaller in a few years' time than it is today. The companies, as everyone on the call will realize, tobacco volumes themselves are in quite serious decline now, and that rate of decline has increased over the last few years. It was running at, let's say, 2 to 3% per annum. It's now sitting at 4 to 5% per annum. And you start to compound 4 to 5% per annum value declines over a few years, volume declines over a few years, it really starts to make a difference. Now, so far, the companies have been very successful in continually putting up prices to offset the volume declines, and thereby maintain a relatively steady level of profitability. But we think actually it's actually the ultimate sign of an unhealthy business when the company is seeing volume declines, but is offsetting them with price increases. Because one day we think that the companies will run out of road, and that what will happen is that the price increases will themselves accelerate the volume declines. So the price elasticity will suddenly start to alter. So we absolutely worry about profits from the tobacco pool. The companies are obviously trying to move consumers away into what they call next generation products. So that's heat not burn, that's vaping, etc. The challenge there is that those businesses, the business model is unproven. So BAT, for example, their target is to get that part of their business to profitability in 2024-25, and they may or may not be successful. But the business model is unproven. And of course, remember that the profit margin on every pound of tobacco revenue is around 50%. So there is an enormous adverse mix shift going on here. So a good example, an example of a sector where optically cheap, but we worry that the profit pool is in structural decline.
Brilliant, thank you. Could you just go through which non-UK stocks you hold in the portfolio? And would you be able to talk about the dividend policy, revenue reserves, and current gearing in the trust?
Yeah, okay. So lots in there. So I won't get them all, but the overseas names in the portfolio, there'll be names such as Total Energies, where we like the energy sector. We talked about it a little bit. We recognize that there's always, however much you like a particular industry, there's always stock-specific risk that comes from any individual holding. So we want to use here's an example where we want to use the overseas flexibility to diversify away some of the stock specific risks. So we have a decent position in Total Energies, recognizing that ultimately it's the same economic exposure that you get from BP and Shell. Then I suppose you get more idiosyncratic names, companies where they perhaps may operate in an industry which is not available to UK investors, where we think the valuations are attractive. So we have Hewlett Packard, which obviously is PCs and printers. We have CK Hutchison, which is a Hong Kong listed infrastructure company. That's on a P of 5. We have Honda in the Japanese car maker, and the most recent purchase in the trust is actually a company called Stellantis, which is the old Fiat Chrysler, which of course is a global car manufacturer, but essentially listed in Europe. That's on a price earnings ratio of around 3.5 times. So a mixture of what we would call idiosyncratic exposures and companies which allow us to diversify away stock specific risk in sectors that we particularly like.
Gearing.
Yeah, so gearing has remained very. The trust has the ability, has borrowings of 75 million quid. The assets in the trust are between 700 and 800 million quid. So that puts with markets where they are today, that puts a natural cap on the gearing at around 8 or 9%. I think the gearing on the trust today is at around that level. We're naturally very cautious on gearing. However much we believe that a particular group of stocks is underpriced, that doesn't mean that they're obviously in the short and maybe even the medium term, that the share prices can't go down very dramatically from where they are today. And of course, the COVID pandemic was a great example of how an unexpected event can create stress almost overnight. We never, ever, ever want to get into the position where the trust is forced sellers of stocks at low levels because gearing is simply going up arithmetically as a result of the fact that the assets have declined significantly. So we will always want to keep gearing below 10% anyway. As far as the dividend is concerned, the dividend on the trust, so that the share price today is around £2.20 on the trust. The dividend expectation for this year is around 9 to 9.5p, that sort of level. So you're at a dividend yield of just over 4%. Although we're only into July, so obviously there is some uncertainty surrounding the final level of dividend that the fund earns.
Brilliant, thank you. I'm conscious we've gone over the hour. We do have a few more questions, but we can see who's asked them, so we will follow up individually with you as we've run out of time. But I'd like to thank you both very much for your time, and also for everyone who's been listening into this webinar. And we look forward to talking to you again soon. Thank you again.
Thank you.